Hello, I'm Leo, and this is Finance English in 8 minutes, where you learn finance through CMA concepts, BI insights, and AI applications in a simple and practical way. Let me ask you a simple question. Who actually uses financial statements? Most people would say accountants, maybe finance teams, maybe auditors, and that's it. But here's the truth. Financial statements are used by many different people, and each of them looks at the same numbers in a very different way. And if you don't understand this, you don't really understand finance, because finance is not just about numbers, it's about perspective. Let's break this down. There are 5 main groups of users: management, investors, lenders, suppliers, and regulators. Each group has a different objective, a different question, and a different way of reading financial statements. Let's start with management. This is the internal user, the people running the business: CEOs, CFOs, department heads. They use financial statements to make decisions. They ask questions like, are we profitable? Which products are performing well? Where are we losing money? What should we change? For them, financial statements are not just reports, they are tools for action. Now let's move to investors. These are the people who provide capital: shareholders, private equity, venture capital. They care about return, growth, and risk. They ask, is this company worth investing in? Can it generate future profits? Is the growth sustainable? They focus on trends, margins, return on equity, and long-term value. Now let's look at lenders, banks, financial institutions. They care about one thing: can the company repay its debt? So they focus on cash flow, liquidity, debt levels. They analyze, can this company survive? Can it generate enough cash to meet its obligations? So while investors look at upside, lenders look at downside risk. Now let's talk about suppliers. They are often overlooked, but they are important. Suppliers extend credit. They deliver goods before receiving payment. So they want to know, will this company pay us on time, or late, or not at all? They look at working capital, payment history, short-term liquidity. Now, finally, regulators, tax authorities, government agencies. They use financial statements to ensure compliance, to calculate taxes, to monitor financial reporting standards. They are not focused on performance, they are focused on accuracy and rules. So here is the key insight. Same financial statements, 5 different perspectives, 5 different questions, 5 different decisions. Now let's take a simple example. A company reports strong profit. Management sees opportunity, they want to expand. Investors see growth, they are excited. Lenders look deeper, they see high debt, they become cautious. Suppliers notice delayed payments, they reduce credit terms. Regulators focus on compliance, they check if everything follows standards. Same numbers, completely different interpretations. This is why finance is not just about preparing reports, it is about understanding your audience. A good finance professional knows how to communicate numbers to different stakeholders, because what matters to a CEO is different from what matters to a bank. And this is where many finance teams fail. They produce one report, one format, one explanation for everyone. But that doesn't work, because different users need different insights. Now let's connect this to BI. With BI dashboards, you can customize information. You can create different views for different users. For example, a CEO dashboard focuses on high-level KPIs, revenue, profit, growth. A finance dashboard goes deeper: cost structure, variance, cash flow. A sales dashboard focuses on performance, customer, product, region. Same data, different perspectives delivered in the right way. Now let's go further with AI. AI allows you to personalize insights automatically. It can identify what matters to each stakeholder. It can highlight key changes, generate explanations, even suggest actions. For example, for management, AI can suggest cost optimization. For investors, AI can highlight growth trends. For lenders, AI can flag liquidity risks. So instead of just reporting data, finance becomes a communication function, turning data into insights tailored for decision makers. Now let's step back. Why does all this matter? Because if you don't understand your audience, you might present the right numbers in the wrong way, and that leads to bad decisions or missed opportunities. Finance is not just about accuracy, it is about relevance. It is about making sure the right people get the right information at the right time in the right format. So next time you prepare a report, don't just ask, "Are the numbers correct?" Ask, "Who is going to use this? What decision will they make? What do they really need to see?" Because that is how finance creates value. Now let's review some key phrases. Stakeholders, people who have an interest in the business. Financial statements users, groups that rely on financial reports. Liquidity, the ability to meet short-term obligations. Return on investment, the profit generated from an investment. Credit risk, the risk that a company cannot repay its debt. If you understand these concepts, you are not just preparing reports, you are communicating value. If you found this episode helpful, make sure to follow or subscribe to the channel so you don't miss the next episode. Because in the next episode, we will explore the difference between accounting and finance and why it matters more than you think. Finance is not about numbers, it's about understanding people and helping them make better decisions. I'm Leo, and I'll see you in the next episode.